Thank you. It's good to be here. We're going to talk about market structure. We're going to talk about Michael Lewis's book, Flash Boys, and we're going to talk about the cause and the cure of the debacle that we're in today and the fact that investors have lost confidence in our market, and we're going to talk about why. Then we're going to talk about something fun. We're going to talk about playing blackjack and how that is similar to beating the S&P 500. We've all seen the headlines. HFT, everybody's blaming the HFT, high-frequency traders. But who's really to blame, and what caused this problem? My good friend Steve Butler says that profits are being drained from mutual funds and pension funds. Investors have obviously lost confidence in our markets. We had the flash crash, we had glitches, computer glitches, and we've had these two books by Scott Patterson and Michael Lewis. Michael Lewis had errors and omissions in his book, but I think his message was spot on. It's in fact a tax on everyone: prop traders, hedge funds, individual investors. Now, the markets are a lot better than they were in the 90s. There's no question about it. But they're inefficient and they're unfair. But where are these dollars going? These are the tax collectors. If it's a tax on everybody, who's getting that money? The 13 exchanges, the 45 dark pools, the high-frequency traders get some of it. And then we have the vendors that serve them, and then the increased regulatory burden on all of us. So what was the cause? I believe it was Reg NMS, the order protection rules specifically. And it said that if you have a market that's 1-2, if there's a 2 offer out there, I have to go get the 2 offer before I can bid 2 on my exchange. And that requires every participant in the market to have connectivity to all the exchanges, which is a tremendous cost to everyone. What Reg NMS did is it created competition with exchanges, but it also created an oligopoly with high-frequency trading firms. I did some research on looking at how Reg NMS was created. And it was actually created, there was a 3-2 vote of commissioners in 2005 when it was adopted. It was then implemented in 2007. I talked to both Cynthia Glassman, and Paul Atkins. And they said, here's what they said in their 44-page dissent of Reg NMS. They said, we believe that Regulation NMS turns back commission policy regarding competition and innovation and sets up roadblocks for our markets. Far from enhancing competition, we believe that Reg NMS will have anti-competitive effects. In speaking to them about 3 weeks ago, they have not changed their mind. Now, what's the cure? The cure is just to rescind Reg NMS. That's the simplest solution. But there's a tamer approach also that is advocated by Manoj Narang at TradeWorks. And what he says is that if a 2-cent wide spread in the market is good, a 1-cent wide spread is even better. And then a 0 spread would be even better. Why shouldn't the public be able to buy things at the same price that they sell them at? If one professional is willing to buy it at a price and somebody is willing to sell it, it should give the option, the public investor should have the option of doing whatever he wants. I talked to a friend of mine, Tom Petterfee, who is the chairman of Interactive Brokers. And he had a conversation in somewhere around 2000 or before Reg NMS was implemented with Bernie Madoff. And Madoff argued that there should be a 1 cent wide spread, when in fact, I don't believe there necessarily needs to be, and we could have locked markets. I find it very interesting that no one really seems to get this. Whether it's the media, Congress, or whether it's the New York Attorney General. They should be talking to industry experts. And shouldn't industry experts understand this issue? So I'm thinking, am I crazy? Why don't people get it? Well, I think there are a number of reasons that people don't understand it. One, they haven't read Michael Lewis's book. And I would encourage people in this audience to read it cover to cover. And from that, you'll get the bigger picture. I have a friend, Warren Langley, who's the past president of the Pacific Stock Exchange. And in describing this issue, why don't people in the industry understand that the rules that were created, everybody's playing by the rules that were created. We have to look at the rules, we have to change the rules, and then we'll have a more efficient and fairer market. And he says that it's very difficult to think about the health of a forest when you're cutting down trees. And everybody in our industry is cutting down trees. I was talking to a friend of mine who was a past chairman of the American Stock Exchange at a conference recently. And when I talked to him at a cocktail party, and I said, what really caused this debacle with high frequency trading? Why has everybody lost confidence in our markets? And he said, it's very clear. It's Reg NMS. Then later, the next day, I asked him the same question at a conference in front of 400 people. He completely ducked the question. He came up to me later after the conference and he said, Blair, I'm really sorry, but I'm not independently wealthy and I need to earn a living. So with this gentleman, what happened is his greed trumped social responsibility. He knew exactly what the answer was, but he wasn't willing to tell it. And I'm afraid that the industry doesn't see the forest from the trees, and also when they do, they're not willing to talk about it. But I'm hopeful that our regulators will look at this from 40,000 feet, see what the issue is, and change it. But I can't really do anything about that. But what we need to do is talk about something fun. We're going to talk today about playing blackjack and beating the S&P 500. We're going to talk about the similarities with both strategies, where we're using 10 indicators and cards in blackjack, and then we're using 10 indicators in the S&P 500. This is my first trading experience. I played for 5 years, from 1971 to 77. And I used a strategy that was developed by Ed Thorpe in a book called Beat the Dealer. Now this book actually originated with an academic article in 1958. And what they did is they came up with what the basic strategy was. And that was, what do you do in every situation? Whether you have if there's 17 up, and you have a 10, you stand. 16 against a 10, you hit. What do you do with a pair of aces? You split them. So if you knew precisely and you could memorize the basic strategy, you'd then have an even chance at playing blackjack. So how did we develop a winning chance, a winning opportunity? Well, what they did is they took out cards from the deck. And they took out, in this case, they took out the fives. Let's say you take out fives. You actually have something like a 3.29% advantage. That means you win $3.29 for every $100 you bet. And let's say you take out aces, take out all the aces. You actually lose 2.72. You can see that the smaller cards have positive numbers and the 10s and aces have negative numbers along with the 9. The strategy that they came up, one of the easiest strategies, there must be 10 or 20 strategies, but was to count 2 through 6 as +1, 7 8s as 9s as neutral or 0. And 10s and aces is -1. And every time you had a positive count, you bet actually the number of units of the positive count. So if you had 5, if the count was +5, you bet $5. If you had a count of +1, you bet $1. If you had a count of 0 or negative, you bet as little as you could. We'll see that 21 is similar to the S&P 500. If we can count the indicators as bullish and bearish, and we can assign a value to them, then we can get an advantage playing the S&P 500. I played very seriously for 5 years, and these are some of my numbers. If you see that .008, that means that I actually won 80 cents for every $100 I bet. But the most important thing was that I was able to be disciplined and accurate, and I was serious all the time. I played regularly. I played 8 hours a day, and I followed the strategy completely perfectly. Here's my second trading experience. This is, you actually started on the Pacific Stock Exchange, not the CBOE. But I did trade on the CBOE for about 8 or 9 years. And even though I was playing 21 and trading options, I was continually interested in timing the market. I felt there were indicators out there, economic, fundamental, technical, that actually could predict the S&P 500. And so in 1981, I wrote a paper and did some research on this. I happened to be on the same panel with Ed Thorpe, who was talking about greed and fear in the market and how fast the market went up and down. But these were my findings with the study that I did. I felt there was a significant potential to time the market, but the returns that I could get were not comparable on a risk-adjusted basis to what I was earning in Blackjack or in options. So it was good that I did this research at that time because I had very little money. Proprietary traders earn a lot of money. They get very good returns, but they can't deploy a lot of capital. The S&P 500, though, you can deploy a lot of capital. So for the next 18 years, I concentrated on trading options. And this is the result 18 years later. Hull Trading Company we were on 26 exchanges in 9 countries, and we'd actually filed an S1 to go public. But Goldman Sachs came along and said, I don't know about that. We'll offer you a premium, and we reluctantly said yes. This is what the New York Times said about that transaction. It said that Goldman was looking for new ways of trading securities. I was always fascinated with predicting the market. And about somewhere in the early 2000, I picked up a book by a gentleman by the name of Rick Anderson. And in most cases, when I read a book that I like and I have questions about it, I call the author. The author is always excited to hear from you. He's excited that somebody read his book. And in this case, I actually hired Rick Anderson. He is now our chief investment officer. And in 2006, he thought he had a way of predicting the market. He thought that he wanted to implement it. And so I said, okay, you can buy 100 SPUs. You can go 100 S&P 500 futures long or short. And these are the results of this strategy. You can see down on the bottom we don't have the daily returns, but he made money every year. And in 2008, he made a little bit of money. Now at the same time, I had a passive portfolio that was about 60% invested in equities, and we got killed that year. This looked quite promising. I've always tried to stay close to the academic world. And in 2010, I attended the American Finance Association in Chicago. And I saw an article that was on the Baltic Dry Index, that an author said that the Baltic Dry Index actually led the S&P 500. Well, that led me to do some more research. And during that time, we looked at a number of, must have looked at over 100 articles, academic articles, with indicators. And what we did is we did a walk-forward simulation. We said, well, what if we didn't know this data in advance, but we'd build the model every 2 weeks, and then we'd trade for 10 days. Build the model, trade for 10 days. And we were very careful to avoid any look-ahead bias. These are the results of the walk-forward simulation. The top line is the wealth that would have been created by the strategy. On the bottom, you see that we have that on average the position is long. Typically you'd be long the S&P 500. We actually go short, maximum short, only twice. Once in 2001 and once in 2008, 2009. Here are the results year by year. You can see the Sharpe ratio is close to 1 on a monthly Sharpe ratio compared to the S&P 500 of about less than 0.2. And if you look year by year, you can see that there are actually 4 years that we underperform the market. The market goes straight up, it's hard for us to outperform. Notice that it's not the perfect model. We don't have the perfect looking glass. But as when Blackjack has an advantage of 51.49, this model might have an advantage of 65.35. This is an example of, this is actually a report from 2 days ago. And these are some of the indicators. I'll go down those briefly. The CAPE, that's the Shiller's, Robert Shiller, who won the Nobel Prize. It's his cyclically adjusted price-to-earnings ratio. NOS is new orders, new shipments. BDI's Baltic Dry, the dollar, consumer price index, moving average, that's whether we're in an uptrend or a downtrend. Sell in May is SIM, and an implied correlation is IC. So you can think of this as, let's look at CAPE. That would be as if you saw a 10, and that means the advantage is slightly less to be long the S&P 500. NOS might be, you saw 2 10s. Baltic Dry Index is a small indicator here. But on the other hand, variable X would be as if you saw 2 or 3 5s come out of the deck. So if you keep a cumulative count of these, at this point, our forecast of the S&P 500 would be about 0.5%, 0.54. That's really 0.5% over the average return that we've seen in the last 10 years, which has been about 5. So our forecast for the S&P 500 as of yesterday was, and it hasn't changed significantly, would be about 5.5% over the next 6 months. This is as if you went by a blackjack deck and there was no count, as if you were playing off the top of the deck, because there's no advantage to being long or short. We actually, at this moment in time, have five indicators long, 5 indicators saying short. But that has changed significantly. Earlier, about a year ago, we had a forecast that was as high as 7% over the average return. So we have about 10 indicators. Look at now, going back to the blackjack indication, we have about 10 indicators. Now for the quants in the audience, you can see these are some of the techniques that we have used, that we are using in our model right now. We believe that it is very easy to overfit the data, and as a result, we use something called regularization, and these are the techniques that we've played around with but are not using yet. Now the question is this model complete? Have we done everything we can? No, we're continually looking at new indicators. Now it happens that in the last 6 months we haven't found anything new that we can put in the model. But we're always looking for new indicators, and we're always looking for new techniques that'll give us a better indication. Now, can anyone build this kind of model? It's quite easy. Anybody can do it. All you need is a great data source that you look at every day. You need to scrub the data that you get, because don't believe what the Federal Reserve gives you, because they're giving you the revised numbers, not the numbers that were reported. So you have to go back and look at each report when it occurred and put it into your own spreadsheet. You also have to hire 2 PhDs in math or statistics. And most importantly, you have to be religious about implementing the strategy every single day, rain or shine. John Cochran is teaches the Advanced Investments course at University of Chicago. And here's a few of the things he says about using this kind of strategy, which he considers a value strategy. He says that following this kind of a strategy requires a contrarian spirit. You would have missed the 90s bull market, but you would have done well in the bust. You had to buy in the middle of the crash in the winter of 2008, 2009. You have to be unpopular. Be able to sit by and watch your buddies get rich and buy when they're selling. You have to buy in the middle of the depressions, and you have to sell in hot booms. Now, what are we doing with this strategy? Well, first of all, we have 10% of our assets in this strategy and have had for the last year and a half. But we're also in registration to provide an active ETF. We talked about the cause and the cure of high-frequency trading, and I believe that's Reg NMS. We talked about beating the S&P 500 by using the same strategy that you'd use if you played blackjack. And I believe that just as it was irresponsible to time the market during the last 30 years, that in the next 30 years, it will be considered irresponsible not to time the market. Thank you.